Welcome back to the Crypto Intellect, the channel where we cut through the noise, focus on the facts, and take a deeper look at what could be shaping the future of XRP. Today, we're diving into one of the most talked about predictions in the XRP community right now. Jake Claver has once again made headlines after suggesting that XRP could see a move into the $8 to $25 range. And according to him, if it happens, it won't be a slow climb. He believes the move could be violent, sudden, and catch the majority of investors completely off guard. Now, before you dismiss that as another bold crypto prediction, it's important to understand the reasoning behind it. Because whether you agree with him or not, the framework he's laying out is getting a lot of attention from serious investors. So stick with me as we break down exactly what he's saying, why he's saying it, and what it could mean for XRP holders moving forward. One of the most striking statements Claver continues to make is that the overwhelming majority of XRP holders still don't fully understand what they own. That's a bold claim, but he doesn't say it as an insult. In his view, it's a warning. He believes most investors are evaluating XRP through the wrong lens. Instead of looking at it as infrastructure for a future financial system, many people still treat it like a speculative trade. They watch daily price movements, celebrate green candles, panic over red ones, and focus entirely on short-term action. Claver argues that this mindset causes investors to dramatically underestimate XRP's potential role in global finance. Whether he's right or wrong, it's an interesting perspective because it shifts the conversation away from charts and toward utility. If XRP eventually becomes integrated into larger financial systems, then its value proposition changes completely. And that is the foundation of nearly every argument he makes regarding future price appreciation. Before we get into the actual numbers, it's worth talking about who Jake Claver is and why people pay attention when he speaks. He's not simply another social media influencer throwing out price targets for clicks and engagement. Claver is associated with institutional and high-net-worth investment circles through Digital Ascension Group, where his focus has centered around digital assets and emerging financial technologies. Because of that background, many supporters argue that he has exposure to conversations happening at levels most retail investors never see. Now, that doesn't automatically make every prediction accurate. Nobody has a crystal ball. But it does explain why his comments often generate significant attention within the XRP community. People aren't necessarily listening because he predicts higher prices. They're listening because his perspective is rooted in how large capital allocators may be approaching blockchain technology and digital assets. And in markets, understanding how big money thinks can sometimes be just as important as understanding the technology itself. One phrase Claver has used repeatedly stands out more than any price target. He has referred to XRP as potentially becoming the most pristine collateral in the world. That's a very different description than calling it a payment coin or a cryptocurrency. When you hear the word collateral, you're talking about an asset that can be used as a foundation within financial systems. You're talking about something trusted enough to support transactions, settlements, lending, and liquidity. That's a much larger concept than simply sending money from one wallet to another. Claver believes XRP's characteristics could eventually position it as a critical component in financial infrastructure. Again, this isn't about what XRP is today. It's about what it could become if institutional adoption continues expanding over the coming years. And that's an important distinction because many critics attack his future projections while focusing entirely on current market conditions. His thesis is built around future utility, not present-day speculation. Now let's move into the prediction that's generating so much discussion. Claver has suggested that XRP reaching somewhere between $8 and $25 isn't as unrealistic as many people think. What's interesting isn't just the number itself. It's the way he believes the move would happen. According to him, XRP isn't likely to climb steadily and politely through every price level. Instead, he expects the market could experience a rapid repricing event. In other words, price could move much faster than most participants anticipate. This is where he uses the word violent, not because he's predicting chaos, but because he believes the market structure itself could create conditions for a sharp and aggressive upward move if demand suddenly accelerates. That's a critical part of his argument. He's not describing a gradual multi-year march higher. He's describing the possibility of a market shock that forces investors to reassess XRP's value in a very short period of time. The reasoning behind that view comes largely from liquidity. Claver argues that liquidity above current price levels may be thinner than many investors realize. For those unfamiliar with trading terminology, liquidity refers to the availability of buyers and sellers at various price points. When liquidity is abundant, markets tend to move smoothly. But when liquidity becomes thin and demand suddenly increases, prices can jump dramatically because there simply aren't enough sellers available to satisfy buying pressure. That's when markets can experience explosive moves. According to Claver, XRP may be positioned in a way where a significant increase in institutional demand could overwhelm available supply. If that happens, price discovery could become extremely aggressive. Again, nobody knows whether this scenario will play out. But from a market mechanics standpoint, the concept itself isn't unreasonable. Thin liquidity combined with strong demand has created major price spikes across countless asset classes throughout history. One thing many investors overlook is that major market moves rarely feel comfortable while they're happening. When people imagine price appreciation, they often picture a smooth staircase upward that gives everyone plenty of time to react. Reality usually looks very different. Markets tend to move when the majority least expect it. Claver's argument isn't simply about reaching a specific number, it's about the nature of the move itself. He believes many investors who are waiting for confirmation may find themselves chasing price if a major breakout begins. That's because significant repricing events often happen faster than emotions can adjust. One day, skepticism dominates the conversation. A few weeks later, fear of missing out takes over. We've seen this pattern repeatedly across financial markets. Whether it's stocks, commodities, real estate, or cryptocurrencies, major moves often begin when confidence remains low and end when optimism reaches extreme levels. Of course, a move of that magnitude would require meaningful catalysts. Hope alone doesn't drive markets. Claver's thesis depends on several developments that he believes are already unfolding. One of the biggest is institutional accessibility through investment products. The easier it becomes for institutions to gain exposure to XRP, the larger the potential pool of capital that can enter the ecosystem. Historically, institutional participation has transformed markets because the scale of available capital is dramatically larger than retail participation. If barriers continue to fall and regulated pathways continue expanding, Claver believes institutional demand could become a much bigger factor than many investors currently appreciate. This is particularly important because institutions often operate on entirely different timelines than retail traders. They spend months or even years evaluating opportunities before allocating capital. By the time the public notices activity, the groundwork may already have been laid. Another major pillar of his argument revolves around Ripple's broader expansion into financial services and infrastructure. Claver frequently points to Ripple's efforts to build relationships, expand custody solutions, develop institutional products, and position itself closer to traditional financial systems. From his perspective, these aren't isolated developments. They're pieces of a larger strategy. He believes Ripple is building infrastructure designed to support long-term institutional adoption rather than short-term market hype. Whether every initiative succeeds remains to be seen, but the overall direction is clear. Ripple continues pursuing opportunities that connect blockchain technology with existing financial networks. For Claver, that's significant because infrastructure tends to create lasting value. Technologies that become embedded within financial systems often generate far greater impact than those driven purely by speculation. That's why he spends so much time discussing business developments rather than focusing exclusively on price charts. Regulatory clarity is another factor that appears repeatedly throughout his analysis. For years, uncertainty surrounding cryptocurrency regulation created hesitation among institutional participants. Large financial organizations generally avoid areas where legal and regulatory risks remain unclear. Claver believes that as regulatory frameworks continue developing, many institutions that previously stayed on the sidelines may become more comfortable engaging with digital assets. This doesn't mean adoption happens overnight, but it does mean one of the largest obstacles facing institutional participation could gradually weaken. In his view, regulatory progress acts like removing a roadblock that has delayed capital flows into the sector. Once institutions gain greater confidence in the rules of the game, the conversation shifts from whether participation is possible to how much participation makes sense. That's a very different environment from what existed just a few years ago. What makes Claver's thesis interesting is that he doesn't rely on a single catalyst. Instead, he describes what could be called a convergence event. He sees multiple developments occurring simultaneously: institutional access, regulatory progress, infrastructure expansion, custody solutions, tokenization initiatives, and growing awareness among financial organizations. Individually, each development may seem manageable. Together, they could create momentum that exceeds market expectations. That's the heart of his argument. He isn't betting everything on one announcement or one partnership. He's betting on the cumulative impact of numerous changes happening across the broader ecosystem. History shows that transformative shifts often occur when several trends align at the same time. Markets frequently underestimate these convergence moments because they focus on individual events instead of examining the larger picture. This broader perspective eventually leads into what Claver calls a domino effect. According to this theory, adoption doesn't happen through one dramatic announcement. Instead, one development triggers another. Regulatory clarity encourages institutional participation. Institutional participation increases liquidity and infrastructure investment. Improved infrastructure attracts additional users and businesses. Increased utility generates more demand. More demand encourages further adoption. Each domino pushes the next. That's the chain reaction he believes investors should be watching. The key idea here is that network effects matter. Once adoption reaches a certain threshold, growth can begin accelerating in ways that appear sudden from the outside, but were actually building beneath the surface for years. This is a common pattern in technology adoption cycles. What looks like an overnight success is often the result of a decade of preparation. Now let's address the part of Claver's outlook that receives the most criticism. Beyond his near-term targets, he has discussed much larger long-term possibilities for XRP. These projections often sound unbelievable when viewed through today's market conditions. And to be fair, many people immediately dismiss them. But even Claver generally frames these scenarios within the context of enormous structural changes. He's talking about a future where tokenization expands significantly, where digital assets play a larger role in global finance, and where automated systems increasingly facilitate value transfer. Those are substantial assumptions. Nobody knows exactly how those trends will evolve. However, it's important to separate the long-term vision from the near-term prediction. Even investors who reject the most ambitious projections can still examine the underlying utility argument without accepting every extreme target attached to it. One mistake investors sometimes make is assuming that if a long-term prediction sounds unrealistic, then every supporting argument must also be wrong. That's not necessarily true. A forecast can be overly optimistic while still being built upon legitimate observations. For example, someone might overestimate the eventual size of a market while correctly identifying the direction of industry growth. Claver's supporters argue that this is exactly what critics miss. They focus entirely on the biggest numbers while ignoring the broader adoption trends being discussed. Whether you agree with him or not, it's worth evaluating the underlying assumptions independently. Are institutions becoming more involved? Is blockchain infrastructure improving? Are regulatory conversations advancing? Is tokenization gaining attention? These questions matter regardless of whether XRP ultimately reaches the highest targets suggested by any analyst. At the same time, it's important to acknowledge that Claver has made predictions in the past that didn't unfold according to schedule. That's simply a fact. Markets are complicated. Timelines rarely cooperate with forecasts. Critics often point to previous projections that failed to materialize as evidence that current expectations should be treated cautiously, and that's a fair point. Investors should always evaluate track records. However, Claver's response has consistently been that timing and direction are two separate issues. In his view, infrastructure development, institutional adoption, and regulatory progress take longer than most market participants expect. Whether that's a valid explanation is up to each individual investor to decide, but it highlights an important reality of financial markets. Being early can look exactly like being wrong until circumstances eventually change. As we bring everything together, the central takeaway isn't necessarily that XRP will hit $8, $15, or even $25. The bigger takeaway is understanding why some analysts believe a significant repricing event remains possible. Claver's case is built on multiple pillars. He points to infrastructure, institutional interest, market liquidity dynamics, regulatory developments, and long-term utility. He believes these factors could eventually converge and create conditions for a rapid market adjustment. Whether that adjustment happens next month, next year, or much later remains uncertain. But his argument has less to do with hype and more to do with structural changes occurring beneath the surface. That's why his comments continue generating discussion even among people who disagree with his conclusions. The thesis is larger than a simple price target. At the end of the day, every investor has to make their own decision. No analyst, influencer, or commentator can guarantee what happens next. Markets will continue doing what they always do, surprising the majority. But if there's one lesson to take from Claver's perspective, it's that patience and preparation often matter more than prediction. The investors who understand the underlying thesis before a move begins are usually better positioned than those who start paying attention after headlines dominate the news cycle. Whether XRP experiences the violent move Claver anticipates or follows a completely different path, the conversation reminds us to look beyond daily price action and examine the bigger picture. Thanks for watching the Crypto Intellect. If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and let us know in the comments. Do you think Jake Claver's $8 to $25 XRP target is realistic, or is the market still years away from that kind of move? Until next time, stay informed, stay patient, and keep your eyes on the future of crypto.